Okay. Good morning, everyone. I will call to order the August 14th meeting of the trustee of trust funds. In the meeting with the minutes of our July 17th meeting, and I'll entertain a motion to adopt. So move.
I'll second.
Any amendments, questions, deletions? Hearing none, I'll call the question. All in favor?
Aye.
Aye. And the chair votes aye. All right, so let me give you an update on the Haven Metals. We actually, last time I told you we had found, through the help of Tom Hardiman and Kevin LaFond, we found the original Horse Haven will. Well, again, with Kevin's help, we were able to find an agreement that was reached between the Haven heirs and the city, or the then town of Portsmouth, that amended that. And I had Judy distributed to you. I don't know if you had a chance to review my sort of history of it, but to combine our researchers' knowledge, that's the legal document that has anything to do with the Haven Metals. And then I just added on the most recent 2022 memo and who actually what subject matters were covered in the metals this year. And so I think at this point we probably want to have Bryn come in and tell us what she wants, and then I think we have to decide whether this is something that can just be without having to go through a non-judicial settlement agreement, or we have to do that type of agreement.
What's the question she's asking?
All right, so her question was that the way that the metals are set up right now is there's a series of subject matter metals or excellence in those, and then there is the overall excellence or GPA for each year, one student in each year. But there are subjects in the career technology field which have a certain number of credits, that credit hours that you have, but as currently contemplated, you cannot actually meet those because the credit hours that are available don't meet the minimum. I think what business program motion, it is 5.5. You can say you have 6 credit hours to receive the award. So her on a broader sense, because when she made the request, she said, oh, by the way, if we're going to look at that, can we also look at health technology, not technology, but healthcare, things like that, that I guess they would like to know if there's some flexibility in how the subjects are chosen.
Okay.
And so the reason I added that at the end of my history was to just illustrate that without any discussion with us, these things have shifted over the years, even as recently as the last 2 years, 3 years. And
Where the 6 credit hours come from?
we don't know.
Right.
Yeah, well, so part of the problem is that nobody has a file on this, at least nobody can find it. So presumably, without having to go through a formal agreement, we've gone from Latin and Greek and English composition to things like Chinese and Spanish and et cetera. What is the process by which you can adapt the subject matter of awards to what's actually being taught in school.
But are they asking us for money?
No, no. Well, the only difference we'll make is because, you know, we, as we've always done, along with the scholarships, we identified the amount of money that's available to purchase medals. So these are not scholarships, they're not tied into, you know, where you're gonna go to school or anything. It's just, in fact, as you know, per the Ray Brighton article that I gave you last month, they were giving out gold medals until 1930s when the US got off the gold standard. So it's
I get it. My impression on, you know, having read it through all this is really a school department issue.
well, it's only our issue because, you know, we have an original bequest and then an agreement reached with the heirs of that deceased to give, you know, to take the earnings, we can't touch the principal, take the earnings on that each year and use those toward
The awards.
But it doesn't say for awards for excellence, it says awards in these areas, and that's fair.
Okay.
So you know, I think, you know, my thinking on this, but I'm open to approaching it otherwise is, you know, we ought to get Bryn in here.
You mean Brittany, right?
I'm sorry, yeah, Brittany, Brittany Sullivan, right?
Lind, yes, same person, Lind,
Okay.
yeah.
And find out exactly what they want to do.
Okay.
And then I'll consult with Susan or someone in the legal department, and then we'll come back here.
Good.
And, you know, the answer might not be, let's solve it for 2045. Let's figure a way of adding some flexibility in there without changing the, in essence, of the intent from the original will of the agreement. But that's where we are right now. Questions about that?
Fascinating.
It actually is. Yeah.
I'm pretty shocked at all the documents that you've been able to find. It is pretty amazing.
There's a pretty big gap from 1862 to now, though.
Yeah. Well, you know, thank God.
Other than that Ray Brighton
I
article.
was gonna say, if it wasn't for the Brighton article, we probably would have
Yeah.
never figured out that there was an agreement. All right, so next item on the agenda is Sister City for Cities Trust. So we don't have one yet, but I was contacted by Bob Sullivan, who was asked by the city attorney to prepare a trust agreement to essentially create a fund in which either the city could make donations or private individuals could make donations to build up a financial resource to support the sister city agreements that the city maintains.
That doesn't fit into the ambassador fund that's already created for sister cities?
Apparently not.
Okay,
And you know, I don't question.
no, I was just curious.
Yeah. Why don't you send that around to us?
Even better.
So this, yeah, just so we'll have it.
Yeah.
So this is not in ready to review yet. This is just a very first. See that there's only a couple of clauses, but the reason I just wanted to, you know, Bob hasn't really even asked for our comments at this point, but I know because of the way we've talked about these new agreements in the past, that we prefer a protocol which has the city manager make a request for disbursement along with a copy of the vote by the city council. This does not do that. Why not? I don't know. I haven't had any conversations. This is just, Bob simply, this is a courtesy, just that. But this does not require the city council to approve any disbursement. It's left in the discretion of But presumably, some will be, as it's filled out, more some further direction, but it's still within the discretion of the city manager. As to what monies can be dispersed, or the purposes for which the monies can be dispersed and how much they would be.
Goes by the city manager, written certification.
Yeah. Yeah, so the difference is that, you know, almost all the new ones we worked on, indoor pool and the other ones, they require the city council to make an approval, and then it's communicated to us.
Well, it's interesting because if this is pursuant to a vote of the city council, this agreement,
That's right, yeah, so,
that ought to be consistent with that they have to make the certify the councils.
so that was really the reason I wanted to make you aware of this coming down, because it's different than the normal one. And whether it makes any difference to you, and if you know, if it does, then I'd be happy to reach out to Bob and say, why aren't we following the normal procedure? Now, having said that, I don't think it's beyond the authority of council to decide to set up something in which the city manager is authorized to make a decision. The city does that with leases and, you know, but it's a policy decision that's different than what we've advocated for with trust agreements in the past.
Well, especially since on the committee is a city council person, former city attorney, and the husband of the city manager. So,
What committee?
Just a city.
it's just the city committee.
How many sisters do we have?
We have fewer than we used to have.
Two?
No, they're setting them up all the time. Rich Blaylock went to one country, came back, and I forget where, but they've established a new one.
I guess Carrick Fergus is still. There's also one Wexford or something in the Irish Republic.
Nishinan,
Nishinan. That community in Italy. Where a lot of people settled in Portsmouth. I think Tom Farini's family is from that part of Italy. I know at one point we had close to 10 or something. So we just wait until we get a final draft. Do you want me to flesh this out?
I'm okay either way. Good person.
I want to vote of the city council.
Well, can't promise you get that, but at least.
Well, I'm gonna call one, so find out why he would propose something that isn't consistent.
Okay, well, I only because there's a change, I wanted to bring that to your attention.
Yep.
So we'll keep that on an active list, get this fleshed out.
Right now, if they need money, what do they do?
They have been going through the ambassador, you know.
Yeah,
And I think the city paid for some things too, I don't want to speak out of turn, but I feel like the city picked up a couple of things too.
Yeah, I should see that ambassador's trust, understood.
yeah, I think that was set up primarily when former mayor Eileen Foley was named the ambassador to mostly Michigan, but.
Yeah, and it might not cover, it might not cover, but at least it's in the trust, you know what I mean?
Right.
I don't know, I know that there is one though, so I'm happy to give you a copy of it so that you can be sure that.
Okay, yeah. But I think where the rubber will hit the road is what kind of expenditures are invasion, then you can see that the purposes are a work in progress. It it's clause 5, it's got A through D, and then it has a blank E and F, so. But my sense is that the whole purpose of creating the Sister Cities Committee is to sort of rev up the communications, interactions that we have with these communities. And that probably means having to allocate some funding. And also, maybe presents an opportunity for a private contribution to support that. All right,
So this says paying for travel expenses for individuals for purposes authorized for the trust. I'm not sure I read what the purpose is.
that is the purpose.
That is the purpose.
Who said that? Yeah, well, it's. That's the specific purposes for which the trust funds may be expended.
Might want to have Bob look at how that's all worded.
Yeah. Well, as I said, this is just a very, very early draft. And I know that he's working with the city librarian. Is she part of the committee as well? You know that here.
So,
The city librarian, Christine. Is she on the Sister Cities Committee?
well. You can't put any new people on it.
You can be on it.
No, I don't.
All right, so that covers our 3 topics. When John comes on, you want to tell us what we get, checks and stuff?
Yep, I've got 2 checks here for futures for their costs for salary and admin. Remember, we received the money in last month. Now this one check is for 38,000, the other one is for 26. Request for the superintendent. Last year it was 55,000. This year it's around 56. So just a little increase in those. But they did ask for 2 separate checks. The requests are behind it.
Is it expected the admin will equal the 118,000 that we got last?
No, it does. They usually come in for about 55, 56,000.
So,
And the balance stays with us?
Stays with us.
And the
to be
100,
used for what? That's, I know it's. That's my fault.
That question.
and the 118 comes from the New Hampshire
Charitable.
Charitable Fund,
Correct.
and that's the just dividend? Or the earnings that,
Yeah,
is it 100% of the earnings?
well, it's gotta be, there's gotta be more than one trust because. They give out more of that in scholarships.
Yeah.
So some of the checks, the scholarship checks come from charitable fund.
I see,
Scholarship checks.
thank you.
Always the fun part. The monies that go to kids.
It's nice to see it go out.
For the West Coast.
Can't remember in the first batch if there were any, there weren't that many. Most, you're right, most of them are over. See,
There's a
there was
lot
one,
of
there was a,
24, 16, 66.
yes,
That's weird.
yeah, they had one group that they divvied up. And one scholarship, they divvied up differently.
I'm gonna. Bobby.
Wow, it was a $6,000.
Morning.
Morning. Hi, John. How are you doing?
What's everybody doing?
Hope you brought your parker with you. Air
Oh,
conditioning
chilly in
turned
here.
on all the time. The fun part for which we appreciate all your efforts.
Oh, yes,
These are the scholarship checks.
that's fabulous.
It's been a hot summer in DC. Very hot.
It's very, very sticky, very hot.
I was watching the tennis tournament on TV. The weather was good.
Yeah, it's been oppressive. When I left, it was very nice, because we had, Debbie came through,
Oh, right.
that's much needed rain. So,
Have our share of hot humid weather here in northern New England.
Yeah. More than usual.
Seems like
Nice
that's
right
the
now.
trend. One of the best weather records we have are, think of all the fishing camps in northern New England, across Vermont, New Hampshire, and Maine. And people would diligently record when the ice went away each spring. Just, on the side of the cabin by the water. So going back to the mid 1800s, they have this data. Ice out is now like 3 weeks early.
Really, 3 weeks.
Yeah, like creeping into late March, early April. Yeah. So interesting data. But I don't think our northern New England summers are getting less hot. It's goodbye.
As long as you like Virginia weather, then things will be fine. Okay,
Shall we dive in?
we should.
Great.
Welcome.
Thank you. Good to see you all in person. Looks like you all have both the Q2 deck, which I'll speak to, and also the July dashboard report. In preview, I will tell you that as of August 14th, we're back to June 30th values. So, yeah, it's been a really interesting third quarter thus far. And so if you turn to page, in the big deck, if you turn to page 4. Yeah. And if you look just in the table on the upper left, the 12.66 million market value that you see for what is the scholarship fund. That's exactly where we are today, versus 12.9 million at the end of July. So it's been a good year no matter how you look at it, but since the end of July, we're down a couple of percent. So basically back to the levels you see here. I'll remind you, all four of the portfolios are managed to the same model. So all of the comments that I make to the scholarship fund apply to all of the portfolios. Compositionally, see in that pie chart, blue is stocks, yellow is bonds, and purple is international stocks. So you kind of quickly see you've got a 75-25 allocation between stocks and bonds, aligned with your IPS target. And the composition of the portfolio are 10 passive ETFs. ETFs meaning exchange traded funds, similar concept to mutual funds. And all of the strategies are deploying a passive approach. So none of the underlying products are trying to decide if it's better to buy Coke or Pepsi. You really own both Coke and Pepsi, as represented by the contents of the index or the indices. And that's also consistent with your IPS and has served the organization well. These passive ETF portfolios continue to be the best performing portfolios that I see across all of our investment models. So that's benefited the organization. Again, kind of on the far right side there, just in terms of the detail underneath the high level asset allocation. You've got 4 equity strategies that I'll show you the performance detail in a second, but the very top large cap core, that's your S&P 500 fund. The large value dividend segment is an allocation to the Russell 1000 value index at about 10%. And you can see a 5% allocation to small and mid cap stocks and a roughly 5% allocation to national through the MSCI EAFE index. On the fixed income side, it's a little more granular. You've got 6 ETFs. This is where the yellow dots start. Very modest allocation to high yield, 2% in total, split between floating rate bank loan products and fixed rate high yield bonds. Predominantly within that 25% fixed income, you're in the intermediate bond strategy. And then you've also got a short bond strategy, about 2% allocation to cash. Your fixed income model is roughly 70% US government bonds, 30% corporate bonds, including the high yield, about a 5-year effective duration. And so duration is the statistic that we use to gauge interest rate risk in a bond portfolio. So a 5-year duration, and you can think of it almost perfectly analogous to average maturity. So the bonds in the portfolio, roughly 1 to 10 years. Roughly a 5-year average maturity. What that means is a 1% interest rate move should correspond to about a 5% change in value of the bond. Very high average credit quality, single A. Your bonds are currently kicking off a yield that's close to 4%. So in the just over 3 years since we built the portfolio, we obviously built it in a much lower interest rate environment, but so those bonds have matured, we've reinvested at higher rates. Your fixed income yield is now definitely higher. If you look on the left side of the page in the middle, the performance section, the quarter to date number, which is 3 rows down, I'll show you more detail on this in just a second, but plus 1.99% for the quarter. So that's period ending June 30th. All of that, call it 2%, has been driven by the S&P 500. Any diversification in Q2 away from the S&P 500 is actually detracted from anybody's portfolio's performance. That said, quarter to date has been, like I said, really interesting. As I mentioned earlier, it's getting a little ahead of ourselves. We'll go over this when we talk about Q3, but just in the past 6 weeks, the S&P 500 is down about 2%. Your Russell 1000 value dividend strategy, we've got a 10% allocation, it's up about 1.5%. And then your longest duration fixed income strategy, the 7 to 10 year treasury bond, is up about 4% just in the past 6 weeks. So it's been a real, it's been one of those periods where, when I say we want, despite the fact that the S&P 500 is kind of a train pulling all the markets forward, we want you to have exposure to multiple sources of return. We want you to have diversification away from that. The last 6 weeks have been a great example of why. We'll see how it plays out. With that, if I turn you to page 6, I like this chart because it's not only showing you Q2 performance for each of the holdings, but it's also showing you all of the holdings in the portfolio. So if you look down those first 2 columns, the far left is actually giving you the product name. So at the very top, your exposure to the S&P 500 is via a Fidelity product, which I choose. There's several S&P 500 index funds we have on the platform. Fidelity's has an internal expense ratio of 1 basis point, 0.1%. So it's the most cost efficient way I can gain that exposure. It's also your largest holding. You can see in the middle column, 57%. This is organized by style name, which is the second column, but somewhat conveniently, the first 3 are all equities, and then the very bottom row is your small cap exposure. And if you look at the returns on the far right, again, this is just for Q2. The S&P 500 was up about 4.25, by far the best performing segment of the market. Worst performer for Q2 was at the very bottom, the mid cap exposure, -3%. Interestingly, in the month of July, small and mid cap had the largest increases we've seen in a 1-month period. A lot of interesting market activity happened in July, which we'll talk about more. And then everything in the middle is predominantly your fixed income holdings, basically flat. The 5-year US Treasury went up about 10 basis points in the second quarter. So just by virtue of the impact of rising rates on bond prices, you'd expect to see slightly negative bond performance. However, it wasn't such a big increase that it completely offset. So if you look 4 rows down, you can see your floating rate fixed income fund was up 1.6%, and then 3 rows from the bottom, your shortest duration fixed income fund, which is the 1 3-year Treasury, was up about 0.5%. All of which makes sense in the context of what interest rates did, but again, quarter very much driven by the performance of US large cap. And then just lastly on performance, if you turn to page 7, just some comments on kind of allocation and how that played out across performance. So this is showing you not performance on a product level, but performance on a portfolio level. And if you look at that middle column, TWRR, that's your time weighted rate of return net of fees, you can see the 1.99% again for Q2. And then to the right column, you see 2 benchmarks. This is the benchmark, and your COP IPS is your IPS target asset allocation. Pretty much in line. Keep in mind that obviously benchmarks don't have fees associated with them, which in your case is 20 basis points all in. But the detractor in Q2 was largely that 10% allocation to US large value. US large value was down 2% in the quarter versus plus 4% for the S&P 500. So that's where you see a little detraction there relative to benchmarks. If you go down to year to date, which is 5 rows down, the longer term outperformance is not due to the value dividend allocation, but rather your portfolio is underweight international relative to your IPS. And international's slightly positive returns, but well below the US. So when you see the year-to-date calculation of 9.27 versus the IPS allocation of 8.26, and then similarly the custom for inception, second row from the bottom of the data, 5.39% for your portfolio, 4.65. That is predominantly due to underweight international. The portfolio currently has a 5% international weight versus 15% US. The day will no doubt come where international outperforms. So it'll be interesting to see. We are not overweight international as a shop, But it wouldn't be, if history's any guide, if the Fed starts cutting rates, as we expect they will come September, that would lead theory to a slightly weaker US dollar, which improves. So, we'll see.
John, excuse me, could you help me understand, explain the manager benchmark versus city
Yes. Yep,
IPS?
the manager benchmark is a default system benchmark that it applies to any portfolio with a roughly 70 to 80% stock allocation. So if, as a client, you had 70% equities or 80% equities or 75% equities, you're in a risk profile where our system has a default benchmark that consists of 60% S&P 500, 15% international, no emerging market, just developed international. And so that's how you get to the 75%. So it's interesting in the environment that we've been in for quite a while, because the only domestic equity holding is the S&P 500, no small cap, no mid cap. It's consistently outperformed. Does that make sense?
And then the COP IPS is our custom.
It reflects the targets in your IPS, which probably too small to see on the next page, but I'll just quickly tell you, it's 50% S&P 500, 25% US aggregate bond index, 10% in the MSCI EFA index, that's developed international, and then 5% into emerging markets, so 15% international total, and then 5% mid cap, which is reflected in your current portfolio. And then lastly, 5% in the REIT index, the real estate investment trust index, which we don't have any exposure to. That's another one where, the day will come when REITs will outperform, but in light of everything that's happened since the pandemic and the whole kind of hybrid work environment and commercial office space struggling with vacancies, REITs have definitely outperformed with the last few.
Are you comfortable with that benchmark? Is it an appropriate internal benchmark?
For your policy?
Yeah.
Yeah, I suspect, not having been in the room when those were created.
And that was my next question. When were they created, or who created that benchmark?
Again, we're talking about your policy
Yeah.
benchmark.
The ITS benchmark.
Yeah, I couldn't tell you. It must have been, if you don't know, then it must have been trustees prior to you.
It probably some of that carried over from the H&P, and then when we had TV come in and they kind of went through it and kind of helped us rewrite it, I think that piece of it just came over still from when we had H&P.
This is an educated guess, but a guess nonetheless, some of your trusts, you can only spend income. And we lived through, and to a certain extent are still living through, but for 20 years, we lived through a brutally low interest rate environment. And so if you're constructing a portfolio designed to maximize income, REITs would be, historically an obvious place to do it, because REITs, by virtue of the tax advantages that they have to distribute 90+% of their income to shareholders. So you can almost think of them as it's analogous to a bond strategy. And so I can see why that would be in the portfolio. To the extent that we were about to head into a decreasing interest rate regime, I think tactically there probably will be a time for the one, or we would recommend reallocating. So I don't have a strong reason to tell you to take that out. Benchmarks are obviously useful tools, but there's nothing with regards to your target allocations where I feel like
It's just interesting.
you would go astray if we followed them.
It's just interesting, you don't have it in your management benchmark.
Right. The management, but don't overthink that one, that's a really blunt instrument, it's somebody created this system and said. We can't do a custom benchmark for every single portfolio, whether they're 70% stocks or 80% stocks, so they kind of created these buckets. And the truth is, you know, just domestically, the S&P 500 for equities and the US aggregate bond index is getting you a pretty well diversified portfolio, with the one exception being the S&P 500 is becoming increasingly concentrated in 6 or 7 very large tech companies. And so we as a shop would, I doubt there will come a day where we will want to encourage more concentrated portfolios for clients. We generally want you to have that diversification. And one of the main reasons why active managers are having such a hard time simply beating the S&P 500 is they tend not to hold more than 2 or 3% in any one name. And the S&P 500's got 7% allocation to Apple, 7% allocation to Microsoft, about a 6% allocation to Amazon, right? So it's by definition, any active manager who, even if their allocation to technology mirrors the overall index, which is now about 30%, they're probably underweight.
So in our benchmark, help me total up, how much of these benchmarks are in equities? What percent? 50,
I
60?
think it's 75 for both, so in the manager, it's 75. The majority in the S&P 500, and then in yours, it's also
I see 60, 65%.
50 S&P 500, 10% EFA, that's 60, 5% Russell 2500, that's 65, 5% REIT is 70.
And I'm not counting,
And then 5% emerging market.
5%, 65%, okay.
Yeah.
Okay, good.
And in fact, that's really, in most of these periods, why your current portfolio has outperformed the index, because what we don't have in REITs is either in the S&P 500 or in the Russell 1000 value. Yep.
Thank you.
Yes, oh, thank you, great question. That was, not recommending any changes, particularly in light of what we've seen so far in Q3. It'll be really interesting to see how it plays out over the rest of the quarter, but I am inclined to think that the tactical allocation to large value has benefited you so far this quarter. I suspect it will over the remainder of the quarter. With the simplest explanation being, we're now pretty sure the Fed's going to use in September. This has been a long time coming, the market has gotten it wrong.
You preface that, we presume.
Yes.
Pretty sure.
Yes,
I think
yes,
they regret not having.
yeah, well, when, you expect you to remember this precisely, but they last met in very late July. Didn't cut, and then the very next day, we got a really weak employment report. Now, the market tends to overreact to these things, these numbers very often get revised, the data's never perfect, it's one data point, but it wasn't a great look for the Fed anyway, in terms of timing.
And that's the day when the Dow went down 1,000 points.
Yeah, and the one other variable there was the Japanese central bank raised their interest rate from 0.125% to 0.25%. So you could say they doubled it, to an extent you hardly notice, but what happened was the Japanese yen rallied pretty significantly on the news, and that led to an unwind of leverage bets where, this is a little getting deep into the weeds, but for big hedge funds and sophisticated investors that could borrow Japanese yen at zero and then go buy, Nvidia or, the NASDAQ, that leverage started to get unwound. And that's whenever you see really extreme moves like that, it's almost always due to margin calls. It forced selling because of the unwinding of leverage. It actually, it hasn't completely corrected itself, but the S&P 500 was down close to 10% from its high. The NASDAQ was down about 12% from its high. They've recovered roughly half since then. So we really haven't seen it. Those were all the comments I wanted to make on the portfolio. The remaining pages you see across 9 and rather probably 10, 11, and 12 are just the overviews for the other 3 portfolios. So the only real takeaway there is just the market value. Jay, you've already seen the dashboard. So with that, I thought I'd jump into the appendix, which starts on page 14. And just TD's views haven't really changed significantly quarter over quarter. But a few things I wanted to highlight for you on page 14. Fixed income indices are on top. Equity indices are down below. And if you just look at that second column from the left, that's Q2. Again, higher rates on delayed Fed cuts in Q2 led to basically flat total return performance for bonds. Again, at the very bottom row in that fixed income section, US high yield bonds, high yield's done the best. High yield, very modest allocation to high yield. To the extent we get a meaningful stock correction, high yield would be the worst performing segment of your portfolio, but we have a very modest allocation. It's been beneficial. And we really have yet to see a major credit correction. And that's in essence, high yield is all companies below investment grade, so they're going to be the most vulnerable to any disruption in the credit markets. Below that, you see the major equity indices, same theme as you've been hearing over and over with regards to the S&P 500 and US growth being the place to be. That said, we did start to see a rotation in the past 6 weeks of this quarter. We'll see how that plays out. Again, I'll reiterate, your portfolio's predominant allocation to the S&P 500 has left you with, there's nobody doing better than the equity allocation than investors who are predominantly in passive allocations. So that philosophy is searching really well. Couple of slides on rates. Page 15 is showing you 4 different sectors within the fixed income market. You can see the US 10-year Treasury at the far left and investment grade corporate bonds on the far right. Green bars are showing you a 10-year range of rates, and then the gray shaded, the lightly gray shaded bar is the current interest rate. So again, just on the far left, see the 10-year at the end of June was at 4.37, pretty close to the high of the 10-year range, as you'd expect, considering the Fed didn't start raising rates till 2022. However, today the 10-year's at 3.85. We saw a 50 to 70 basis point decrease in interest rates just over the first 6 weeks of this quarter, most of which were in the last 2 weeks. Again, it was on the back of that weak employment report and the market definitively pricing in a September cut. That said, yields are still high enough that fixed income can provide a cushion from a return perspective for a portfolio of stock sell-off. Traditionally, that's what we looked for in bond portfolios, where a diversifying protector when stocks sell off and money seeks a safer ground. When interest rates were 0, there was no ability for bonds to provide that appreciation. As I said, now your 7 to 10-year Treasury fund was at 4% just in the past 6 weeks. So even though rates have come down, we're still at a point where it can act as a nice shock absorber portfolio. Page 16, this is more of an interesting point for you more than it relates specifically to your portfolio. But the point of this slide is to show you that we have a lot of clients who, when the yield curve's inverted as it is, and cash rates are 5%, and then 10-year rates are below 4%, why would I want to buy a longer-term bond? And the reason is because that duration protects you from falling interest markets, and this is, we talked about this in the last quarter as well. So if you look at that circle, it's showing you the composition of the S&P 500 year-to-date total return by the underlying stock. NVIDIA, which makes computer chips, which are particularly in high demand for companies training artificial intelligence models. In the gray box down at the bottom, it's showing you 5 of what used to be referred to the Magnificent Seven. You'll notice that Tesla is no longer on this list. But you'll recognize all these tech stocks: Microsoft, Alphabet, Google, Amazon, Meta is Facebook, and then Apple. So another 32% there. So if you just take those 6 tech stocks, 62% of the index's returns this year just from those 6 companies. And then the remaining 497 stocks in the index, the balance. However, one thing, you ever heard the expression "this time is different," and then the counter argument is it's never different. The one thing I will say about this period in time is these are very profitable companies. Unlike 1998, 1999, referred to as the NASDAQ bubble, the tech bubble, those companies were trading at extreme valuations to either low or no earnings. These companies are all extremely profitable. The issue becomes at what point are they just priced too high? Apple is priced at over 30 times earnings as if they're growing 20 to 30%, and they're not. Their 5-year revenue growth is I think just over 20%. So, is there overvaluation in this part of the market? Maybe.
How much did NVIDIA drop last month?
So it dropped over 20% at one point.
Over 20.
Yeah, and now I think it's that. So again, your portfolio has benefited from the allocation to the S&P 500 because you've got this concentration, but you've got the diversification internationally, you've got the diversification to the value segment of the market. So you're not overexposed. Just 2 charts starting on page 18 on just coming back to the Fed, and I'll remind you the Fed has 2 mandates: price stability, which we measure by inflation, and full employment, which we measure by the unemployment rate. This chart speaks to inflation readings, and it's showing you different weighted averages. But if you look at the 3-month average, which is the green line, this is why they haven't cut yet. You had that slight spike in inflation in the first quarter, which is now abated. That red dot target, and we're getting really close to it. The trend is clearly down, and so our expectation is that they will feel comfortable enough that the battle over bringing inflation down has been sufficiently won that they'll start cutting. We think that we've got, I think in the chart here as of June 30th, we only had 1 easing priced in between now and the end of the year. I think now taking that up to 50 basis points. So that would get the Fed funds rate down to 5% by the end of the year. And then we've got about another 150 forecasted into 2025. And so our crystal ball as it relates to interest rates has not been particularly clear and accurate. Neither has anybody else's. I just saw the statistic the other day. When back during COVID, Fed had taken rates down to 0. They were saying at the time, "You don't see us raising rates until 2024. Now, they actually raised rates faster than we've ever seen in history in 2022, right? So even the Fed and their roughly 200 PhD economists on staff have a really tricky time predicting the economy, but it's, the time is coming. The next chart is just on the employment picture, and so the leading indicators that we follow suggest that hiring is definitely losing momentum. We are seeing increasing announcements of job layoffs. But the unemployment rate is generally over 4%. And so it appears that the Fed has room if they want to start easing rates without wildly disrupting markets. Page 20, I think I showed you last quarter, although it didn't go all the way through June 30th. This is just, this chart just speaks to, do we care which party wins the election? And this chart basically says,
I'm surprised CD will let you come out with it.
with anything of a political nature.
That's true.
Yeah, right, exactly, well, I'll, yeah, try to choose my words carefully. What this is showing you is going back to FDR, the S&P 500 return during that president's term. And if you just look at the very top, the Democratic average 13.4%, the Republican average 9%. Our takeaway is, you know, kind of don't overthink it. The market tends to go up over time, regardless of who's president. I would point out as a little bit of a numbers geek that if you look at Bill Clinton, 5 from the right, and George Bush, and then Barack Obama, that's a really interesting period because Bill Clinton's term ended before the NASDAQ bubble burst in 2000. So he got the, you know, his is the highest return. The market absolutely peaked. George Bush inherited the 80% decline in the NASDAQ. And then during his 8-year term, also ran into the housing crisis. And then, you know, the stock market bottomed in 2009. Barack Obama took over in 2008 and kind of had the benefit over his term of a massive recovery and a whole period of zero interest rates. So if you were, you know, as statisticians are sometimes want to do, and eliminate the outliers, if you took those two out, you'd have a much more equal appreciation in the S&P 500 regardless of who's. So anyway, data kind of make it look however you want, but with just a couple exceptions, the market's been positive. So with that, I will make no more references to politics. And then just lastly, on page 21, our forecast. So, okay, yeah, we've since updated this to include 2 cuts. So the very top line is the Fed funds target rate, and we're currently in Q3 at 5.5. We've now adjusted that to 5.25. We're at 5% for the fourth quarter, so 50 basis points this year, and then you can see as you go across through 2025, then 2.5. And just if you kind of stay on that last Q4 25 column, if you've got a Fed funds rate of 3.5, 2-year government bond yield of 3.10, and a 10-year government bond yield of 3.45, that's a very flat interest rate curve. We've been inverted. Longer rates have been lower than short-term rates for a really long time. Flatter interest rate curve is kind of unusual. Again, predicting interest rates is just flat out impossible. But I will say that at some point, the Fed, I don't think they'd ever say it this explicitly, but it out over long-term basis. And while they try to hedge the inherent interest rate risk in their balance sheets, it's much easier when the yield curve's positive. So, and so it's a major incentive for the Fed to start bringing that rate down. They just have the challenge of not wanting to do it too soon.
So I'm confused, John. In September, you projected 25 basis points or 50?
25.
25.
And then another 25 before the end of the year. Okay. Yep. Exactly.
You're on page 21.
Say again?
You're on page 21.
Yes.
You don't think that the GDP is gonna grow much in 25?
tremendous supporter of the economy overall. We think that is probably going to abate over this time period. And so we're not calling for a recession. I am reading from less mainstream economists who think we're already in a recession. If you go back to 2022, and you know this because you see the revisions, even though the market tends to not pay that much attention to it. I think over the first 3 quarters of I said 2022, I meant 2002, when the stock market was corrected. The original GDP numbers were between 1% and 2%, and then all got revised down by the end. It's just what tends to happen. The data gets analyzed over a lag where, we may see 2024 data get revised down if that turns out to be true. We're more constructive than that, but we're not seeing booming growth in the years ahead.
I think
Keep in mind too that these are nominal figures, these are real figures, so they're adjusted for the inflation statistics that you see. Suzanne, what do you think?
obviously, I think if you kind of find about the inflation. Look at the rate of price increases. That rate went up, prices went up, okay, the rate went down, but those prices still stayed high. So when you go to the grocery store, it's still super expensive when you leave. When the rate went down, the prices didn't come down with it, so. Till the earnings go up in a comparable rate, you still have
It's
that,
pain.
you still have that difference. Theory.
Happy to answer any further questions you might have, but
So does that all translate into soft landing?
yes. You got hard landing, soft landing, and no landing, and it's somewhere between soft landing and no landing. Which is the most positive.
Meaning what?
The most positive.
Let me ask you the questions that I usually ask you. Do we make any adjustments in our investment policy at this point?
In your policy,
In the policy itself?
You're comfortable with our allocation, our diversification model?
yes, and your policy benchmarks provide a nice comparison to, the slightly. The tactical weightings away from your IPS are reflecting TD's view. They're not so dramatic that we've got big differences between the two portfolios. It's really at the margin, you can see net contribution or detraction from performance. It's been net positive over the roughly 3-year life of the portfolio. Now, your policy, both in terms of the diversification as well as your preference for passive, served you really well. Your portfolio remains really the highest performing of all the portfolios.
You win.
How long do you think it's gonna take for REITs to come back, so, or are they getting out of office in more large scale apartments and stuff like that?
Yeah, there's a great saying in the markets: when it's time to buy, you won't want to. Or Warren Buffett's twist on that is be greedy when others are fearful, fearful when others are greedy. Meaning, when REITs, commercial REITs have struggled, residential REITs done better. Mall-oriented REITs have really struggled. To the extent that the decrease in interest rates, if it's coming by the Fed, in any way coincides with the economic slowdown, they'll probably continue to go down even further. But there will be a buying opportunity there for certain. I get these interesting notifications on extreme examples of office buildings selling at auction, and it's shocking. It's, buildings that they have sold for 250 million, past 5 to 10 years, selling for 25 million. And 70% vacant. But interestingly, even for the new buyer, that cost base is often the rent roll isn't even covering their, their needs to finance the properties. And in many cases, folks are looking at ways, what we need is more housing, less commercial office space. Some buildings seem to be much better suited for those conversions than others. Either way, it's really expensive. So it seems like it's gonna take a while for those values. But again, other segments of the REIT market, residential storage, like data centers. All the big tech companies right now are trying to train their AI models, need massive warehouses with computers. That segment's doing well. But as a generic asset category, it's benefiting from. I would think in the next 2 years. And believe me, I won't know the precise date on to pull the trigger, but I do think it's an asset class, particularly if, right now overnight rates are at 5.5. We project going down to 3.5. The last two Fed eases took us down below 1%. We're not calling for that in this cycle, but if that were to happen, the dividend yields of REIT strategies will start to move. So that might be the catalyst.
So I'm on the board of an organization that develops and manages affordable housing. I think in Greater Washington, we were thinking about looking at opportunities to convert office buildings to housing. It's very, very difficult to do that because of the way they're constructed with the flooring and the ceilings, the heights are not right. And I have to developers for this, but the way they construct like the ceilings and stuff, they're set up so that the wires go between the floors and stuff. It's very, very difficult to convert to.
It almost leads to complete demolition.
Exactly, and then you're talking very, very, very expensive. It's just cost
A lot of the places that have done it is because the cities have given major financial incentives.
Exactly.
To go.
all our properties now.
Yeah.
Incentives from all kinds of people.
Yeah, it's tricky. The pandemic dramatically accelerated a trend that was already in place, but to a degree. We're seeing big companies are having a hard time getting employees back to the office, and strategically shrinking their commercial footprint where they need space. So, it'll just take time in the best case scenario.
Other questions?
Suzanne, I'm just curious, you see a lot of these nonprofits. Is our portfolio similar, different than most that you see? Is there a particular model that's most common?
Yours is very similar.
Similar, okay.
Yeah, but very much so. And more organizations are starting to drift toward the passive model like yours. It's very cost effective and really gets you exposure to the broader market without really taking bets on any one particular segment.
Yeah, no, it certainly worked well for us.
I think we're already on the calendar for October. Yeah.
And that wouldn't be as soon.
So, great, yeah, I know it'll be interesting to see how this quarter plays out. So the past 6 weeks have been very different from the second quarter.
Yeah.
And again, your portfolio is designed to benefit from lower interest rates. And also you've got diversification away from the S&P. So we do see a direction there. When the markets go down, they all tend to go down. But where you see the outperformance is less depreciation, although so far this quarter, the value style strategies are up about 1%. So can't see positive changes there even. Right, well, thank you for your time.
Yeah, thank you, that was a great presentation, very
Enjoy the
good.
rest of your
Thank you for
summer.
coming in.
Yeah, thank you.
Our pleasure.
Stay cool, Susan, Washington.
I'm always cool.
You don't mind if we post this on X when we get out of here?
TD says.
John says.
Thanks for coming.
Thanks, everyone.
Thank you, good to see you.
Okay. From the public to make comments, so let's,
Will we adjourn?
I'll second that motion.
all in favor?
Aye.
Aye.
Uh,
Okay.